A real focus, though, for us here in Canada in our markets is what's going on with the Canadian banks. And there is another short seller coming after the Canadian banks. Denver-based Crescat Capital cites the Canadian housing market helping to lead the Canadian economy, into a recession. However, the big six banks have managed to prove the naysayers so wrong in the past. Joining us now to discuss why he thinks now is the time to strike is Kevin Smith. He's the founder and CEO of Crescat, a hedge fund based in Denver, $53 million in assets under management, and a very good track record last year. Good to be with you, Kevin. Thank you very much for joining us.
Oh, thank you for having me.
I want to get from you the thesis as it relates to shorting the Canadian banks and why now is the time. This call has not worked out for other hedge funds in the United States.
Sure. Well, it really comes down to China, actually, and the China credit bubble that we think is finally in the process of bursting. And I mean, China has this credit bubble has been going on now for a decade in terms of the banking asset growth in that country, and the money has just been spilling over all over the world. But we think the capital flows now from China are really starting to dry up and possibly even reverse here.
So, Kevin, how does that, though, relate to Canada and the Canadian banks? Are you essentially saying that that the concerns out of China, that there's just been so much money flowing out of China into Canada, and that's really what's helped the Canadian economy?
Well, it's certainly been a boost, and I think a lot of people know that there's been a housing bubble in Canada, that the household debt to GDP has been inflated and been a problem for some time. Property prices have been rising for some time, but on the margin, it's really been, we think, the money flowing in from China that's really pushed prices up and forced Canadians themselves to have to stretch to afford housing. And really, honestly, we're 10 years into a global economic business cycle, and we really do believe there is a business cycle. And Canada, when you look at it, it's just one of those countries that has a really high debt to GDP ratio in its household sector. And we think the banks are really the ones that are going to be holding the bag on this debt problem.
But Kevin, walk us through how this will actually happen, the sequence of events. And I ask you that also in the context of a very low unemployment rate and an economy that continues to essentially chug along. I just don't understand, if we connect the dots, what would be the actual catalyst here?
Well, sure. When you look at the timing of business cycles, of economic cycles, really, in advance of every recession, you really see unemployment reach near lows for that cycle, literally months in advance of coming into the next recession. So it's actually a contrary indicator to look at something like employment.
Interesting. Also in your report, I do believe you talk about the everything bubble, that there are so many asset classes in the world that are in fact in bubbles. You talk about China as being, it sounds like the key catalyst and the key concern. On a day like today, though, when the market continues to march higher and, in fact, surge on the potential for easing trade tensions, and China's going to get aggressive in terms of buying U.S. product and also adding stimulus to their economy, doesn't that completely counter your short?
Well, sure. Even in bear markets, you have bear market rallies, and we think this is what we've seen off those Christmas Eve lows. Now, 3 weeks since, we have a rip-roaring bear market rally. But is it a new bull market? Well, we're really only just slightly above that 2,600 level on the S&P 500 that is really the key level that we broke through back in September, October. And we're really only coming up to retest those levels, we think. And when it comes to China, they've created $40 trillion worth of credit in their banking system, and another $50 trillion on top of that in this last 10-year economic cycle. Most of that growth has come during this cycle, and we just think that it's reached the tipping point where that marginal credit can no longer generate marginal GDP growth, and And so we're kind of reaching that Minsky moment, we think, for China.
And Kevin, are you singling out Canada as being most negatively impacted, or are you going, and within that context, are you actually going short the Canadian banks and going perhaps long other banks?
Our hedge fund is more about macro themes, and we will trade off in terms of risk exposure, a long theme versus a short theme, but we're not about pair trading in banks necessarily. So we're actually short Chinese banks, Australian banks, Canadian banks. Those are the three big housing bubbles in the world today. And we had a lot of success back in 2007 shorting U.S. banks during the U.S. housing bubble. We think it's an opportunity now with those three countries.
Do you think that those three countries could cause instability in our financial systems around the world like we saw with the U.S. banks?
Well, certainly we think it's a global debt problem, courtesy of global central banks, starting with the Fed. The Fed, the ECB, the BOJ. But far and away, the largest central bank in the world is actually the PBOC. It's actually China, and so China's been responsible for more than 50% of global GDP growth in the last 10 years, and so certainly it's a globally contagious credit bubble, we believe, and so the trade negotiations with the U.S., whether it's on and off again trade war or trade negotiations, we think anything that might be settled there really pales in comparison to the scale of the 90 trillion combined off-balance sheet and on-balance sheet banking assets that China has created. I mean, a few $100 million on the margin of whether we improve the trade deficit or not is really nothing in comparison to what might be considered an outright Ponzi scheme in a banking system.
In China is what you're saying, $90 trillion Ponzi scheme in China.
In China, we think that Canada is really just its own housing bubble, its own banks. We think will be caught up in a global debt bubble meltdown when this everything bubble does have its inevitable business cycle correction. Canada in particular has a housing bubble because of all the Chinese money that's been pouring in there and forcing its own citizens to also have to go into debt and chase this housing bubble.
Kevin, can you just expand a little bit more, though, on why the Canadian banks would get so caught up in China's debt bubble? I mean, China money flow into Canada aside, the Canadian banks, in terms of the balance sheets, the way they've been run, the mortgage stress tests that have been put in place as of late that have kind of cooled the Canadian housing market. Why do you think, or what is it about the Canadian businesses, the Canadian business banks, that would unravel to such a degree that you're indicating? And my question is also, unravel to what degree? Are you talking about 5%, 10%, or more what we saw in the United States?
Well, in the U.S., the banks were trading at about 1.7 times book value before the global financial crisis. And at the depth of the crisis, they were trading at about 0.7 times book value. But at the same time, book value had been written down by as much as 50% at some of the large banks. And so we see a similar phenomenon. The issue in Canada is that most of the banks are holding the mortgage debt. Canada does not have a big securitization market like the U.S. did, and so it's even more of an acute problem, we think, for Canadian banks. And so if you look at asset write-downs in a housing bust from mortgage write-downs and the deflation of price-to-book values in general, it's pretty easy to get to a 50% kind of a correction for banking stocks.
50%. You actually think that the Canadian banks could decline to the tune of 50%?
At least. At
least, because of the asset write-downs, even though the mortgages are not as big a percentage of the overall banks as they probably were in the States. And also, we don't have, I would think, the problem of securitizing all of these loans and all the derivative products based on that held within these banks and the counterparty risk. Wouldn't that be a positive that we don't have that?
Well, I think more of the mortgages are on the bank's balance sheet compared to in the U.S. that had a securitization market. But the problem is not just the mortgages, it's the entire economy, it's the global economy. I mean, there is a business cycle, there is a macroeconomic cycle, and it's really an asset and everything bubble. It's everything except commodities bubble in terms of equities, corporate credit, real estate, and private equity, private fund assets that courtesy of global central banks and the era of QE that we've seen in the last decade, have inflated all of these asset bubbles to truly historic valuations. And it's a problem in the U.S. too. In the U.S., on a normalized basis, U.S. equity prices got to record valuations across every metric that you can look at. On the PE ratio, you need to look at normalized PEs, but normalized PEs are over 45 times. And this is higher than 1999, higher than 1929. You know, there is a business cycle. Business cycle downturns typically start with security price corrections, with asset price corrections that leads to broader economic problems.
Kevin, what's your timing in terms of when we'll actually see, to quote you, a 50% correction or more in the Canadian banks? And in the same context, I'm asking at the same time, couldn't we just see these central bankers that have been on this path to want to tighten absolutely reverse that? And can't we see China, the PBOC, doing exactly the same thing? In other words, that this elongated quantitative easing actually just gets extended and your short call will not come to fruition?
Well, that's kind of what happened at the end of 2015 when the Fed hiked rates one time and then it was one and done. They paused for a whole year from continuing to hike rates. And I think that was the free pass that we had in terms of a soft landing for the global economy. Since that time, the Fed has continued to raise rates, and now they're pausing again. But when you get to the end of a business cycle and central banks pause their rate hikes, or reverse them, that's the beginning of the downturn. That's not the savior of. That's not the thing that's going to save and extend the business cycle. That's acknowledgement that there's really problems.
Okay, understood. Kevin, great to be able to speak with you today. Thanks so much for your time.
Thank you.
Thank you.